Canada's energy future just got a major boost. One of the country's strongest natural gas producers is joining forces with a global energy giant, creating new opportunities for jobs, investment, and long-term growth. It could help Canada's place in the world energy market.
Eric, it is set to be one of the biggest Canadian oil patch deals in over a decade, with energy giant Shell planning to take over Alberta-based oil and gas producer ARC Resources. In a written statement, Shell's CEO says the $22 billion merger establishes Canada as a heartland for Shell. The Prime Minister labeling the move as a good sign.
It's a vote of confidence in Canada.
The deal comes as the federal government is aiming to fast-track two major LNG projects in British Columbia. Salism's, a proposed LNG export facility that would send over 20 billion cubic meters of natural gas to Asia annually, along with another project Shell co-owns, LNG Canada, which could double production.
For Shell, they understand all of this, and so they could see strong returns from LNG Canada Phase 2, and from developing this, and from the liquids that are associated with it. And it's, bodes well for everything moving forward together.
More Canadian energy agreements may be on the way, with companies seeking new oil suppliers due to global disruptions caused by the US-Israeli war in Iran.
Shell has recently announced a definitive agreement to acquire ARC Resources Limited, Calgary's largest pure-play Montney producer, in a deal with a total enterprise value of approximately USD $16.4 billion. The transaction combines cash and Shell equity. ARC shareholders receive CAD 8.20 in cash and 0.40247 ordinary Shell shares for each ARC share held, producing an aggregate equity value of approximately USD $13.6 billion plus roughly $2.8 billion in net debt and leases that Shell assumes. The boards of both companies unanimously approved the deal. Shell expects it to close in the second half of 2026, subject to ARC shareholder, court, and regulatory approvals. Nearly a decade ago, Shell sold its Canadian oil sands assets, divesting from Alberta's carbon-intensive heavy oil production as the energy industry was pivoting toward decarbonization and away from the highest emission extraction methods. That exit was widely interpreted at the time as a permanent repositioning away from Canadian energy. The April 27th announcement is the explicit reversal of that decision. Shell is returning to Canada, not to the oil sands, to the Montney. The Montney Formation is a geological basin straddling northeast British Columbia and northwestern Alberta that has become one of the most prolific natural gas and liquids-rich shale plays in North America over the past decade. ARC Resources is the largest pure-play producer in the Montney, operating approximately 374,000 barrels of oil equivalent per day before royalties. Of that production mix, 58% is natural gas and 42% is crude oil and other liquids, including butane and propane. ARC's portfolio covers more than 1.5 million net acres across the Montney Formation. Shell currently holds approximately 440,000 net acres in the same formation at its Groundbirch and Gold Creek assets. The acquisition combines these two contiguous positions into a single integrated Montney footprint exceeding 1.9 million net acres, one of the largest single operator positions in the play. Shell CEO Wal Sawan said the acquisition would establish Canada as a heartland for the company and complement its existing footprint in the country. The Groundbirch asset in British Columbia is the specific existing infrastructure that makes the ARC acquisition strategically transformative rather than simply additive. Groundbirch already supplies natural gas to the LNG Canada liquefaction plant in Kitimat, British Columbia, the facility in which Shell holds a 40% equity stake and which exported 1 million metric tons of LNG to Asia in April 2026, a monthly production record. ARC's proved and probable gas reserves, as Shell's own announcement states, can support Shell's growth in LNG Canada. The production and financial metrics attached to the deal are specific and documented. Shell expects the deal to add about 390,000 barrels per day to 2030, generate roughly $1.5 billion of annual free cash flow through the rest of the decade, approximately $2 billion post-2030, and deliver at least $250 million per year of synergies by end of year one. The synergies derive from the geographic contiguity of ARC's acreage with Shell's existing Montney position shared infrastructure, combined operational expertise, and reduce per unit costs from operating a larger integrated development across the same geological formation rather than two separate smaller operations. The acquisition adds approximately 2 billion barrels of proved and probable oil equivalent reserves to Shell's books, based on ARC's year-end 2025 reserve assessment. That reserve addition, combined with the 370,000 barrels per day of immediate production, lifts Shell's combined integrated gas and upstream production compound annual growth rate to 4% through 2030 compared to 2025 levels. The transaction is expected to generate double-digit returns and become accretive to free cash flow in the first full year of ownership. The LNG Canada connection is the element that extends the ARC acquisition significance beyond a conventional upstream producer acquisition. LNG Canada Phase 1 represents the largest private sector investment in Canadian history. It is operational and exporting to Asian markets. LNG Canada Phase 2, a potential doubling of the facility's export capacity from approximately 14 million tons per year to 28 million tons per year, remains a potential but uncommitted final investment decision. The feedstock question for LNG Canada Phase 2 is the central question its commercial viability depends on. Whether sufficient low-cost, long reserve life natural gas can be committed to the facility to support a decades-long export contract portfolio at competitive pricing. ARC's Montney position provides precisely the kind of feedstock answer that a Phase 2 final investment decision requires. The Montney is a low-cost, long reserve life formation. ARC's acreage is highly contiguous with Shell's existing Groundbirch supply position. A Shell-owned ARC, integrated with Shell's existing Groundbirch infrastructure and Shell's 40% stake in LNG Canada, creates a single corporate entity with the upstream production, midstream infrastructure, and downstream LNG export position to evaluate Phase 2 as an integrated investment decision rather than a complex multi-party contractual arrangement. ARC's gas production could service LNG Canada exports, and the wave of other LNG projects planned to come online in British Columbia to ship gas to Asia, a potentially valuable proposition with more of Qatar's gas exports offline for years to come because of damages sustained from the ongoing war in Iran. The Iranian conflict's effect on Middle Eastern LNG availability has tightened the Asian LNG market and elevated spot prices, creating the commercial conditions in which long-term supply contracts from politically stable North American suppliers become significantly more attractive to Asian buyers. Shell had spent approximately $2 billion acquiring assets in 2025, adding roughly 40,000 barrels per day of new production. The ARC acquisition adds 370,000 barrels per day in a single transaction, almost 10 times the production volume Shell accumulated through all of its 2025 acquisition activity combined. Sawan told CNBC's Squawk Box Europe in February 2026 that Shell was not in a rush on M&A and had the space and time to ensure any investments were value accretive. The ARC deal, announced 2 months after that comment, reflects a decision that was evidently in advanced preparation when Sawan made that statement, and that the value case for ARC's Montney position was sufficiently compelling to break from the measured pace Sawan described. National Bank of Canada had identified ARC as a takeover candidate before the announcement. Analyst Travis Wood noted in a Monday research note that the deal underscores the attractiveness of Canadian assets, particularly those in the liquefied natural gas sector, where demand is surging partly due to the push for natural gas-fired electricity to power artificial intelligence data centers. The deal is structured to close in the second half of 2026. Shell becomes Canada's third largest shale producer upon closing. ARC's business will be reported as part of Shell's integrated gas division, the same division that manages LNG Canada, embedding ARC's Montney production directly into the corporate reporting structure of Shell's global LNG strategy,